QuickBooks Online 2025, analyzing reports after doing 1 month of data input. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation, opening up the major financial statement reports located on the left-hand side. We're in the Standard Reports tab, the Favorites section. Right-clicking on that balance sheet to open a link in a new tab. Right-clicking the Profit and Loss, otherwise known as the income statement, also opening a link in a new tab. Let's tab to the middle. Close up the hamburger. We're in the modern view mode, so we're going to select the drop down in that modern view. For the custom dates, tab 010125 tab 013125 tab. It's refreshing automatically. Great. I don't even push the button. Tabbing to the right, closing the ham boogie, selecting the drop down so that we can get to that custom date range tab, going from 010125 tab 013125 tab. Once again, refreshing automatically. These are the two reports that we have been opening every time. These are the major financial statement reports, the reports that are created as we do our data input after having done data input for the first month of operations. Let's get an idea of what's happening with these reports, how are they being constructed, and then go into some detail about the other reports that have also been constructed as we have been doing our data input, but which we haven't really checked on as we do our data input. All those other reports, by the way, can often get very overwhelming to people. But if we look at them as we construct the financial statement, hopefully that'll give a better idea of what they're doing, when they can be applicable, how you can use them, how you can possibly decide which reports you might be wanting to provide to clients if you're a bookkeeper, which I would recommend doing, because that helps the clients know that you have some understanding of basically what you're doing, even if it's just for presentation purposes. It looks nice. All right, so let's go to the balance sheet, give a quick recap of what we have done thus far. So what we've done thus far is we started by taking or setting up our financial statements from a prior accounting system. So we imagined we had some basic beginning balances. By the way, I'm going to close the top ribbon here with this little item. So we imagined that we pulled those beginning balances into our current system, and then we did transactions typical to a new business. That's the need for capital, the need for cash in order to help us generate revenue. So we did transactions that aren't going to be repeated all the time, are typically there when we build the new business or we try to expand to get the money. The money has to come from somewhere, and it's either going to be coming from liabilities, the bank, a loan typically, or from equity, meaning it could come from income, which rolls through equity. But if it's a new business, we don't have any income yet. We need the money before we can start making income. Therefore, it's going to come from the owners. If it's a sole proprietor, one owner, multiple partners. If you got 5 partners, then from those partners. If it's a corporation, it's the issuance of the stock that they pay for to the company that's going to be the initial investment. And then we took that money and we bought stuff that we're going to need to generate revenue. That's going to include property, plant, and equipment, PP&E, long-lived assets that we use to generate revenue, as well as if you have a business with inventory. Then we did 1 month of data input, selling the inventory and doing services generating revenue. Only at that point in time did we actually start having an impact on the profit and loss, otherwise known as the income statement. I'm going to close this up again. So now we have an impact on the income statement, income minus expenses, as in essence we sell things. So let's go through these accounts now line by line and get an idea of what kind of forms build it. So what we've done thus far is we've constructed our financial statements. How did we do that? We basically hit the plus button. We have our forms that do the transactions. So remember, if you're in a textbook, the structure is going to be you do journal entries. The journal entries in accordance to the double entry accounting system, having debits and credits, which are always equal, are going to be feeding in and creating you can post them to the general ledger, and then the general ledger is going to create the trial balance, and then the trial balance is going to create the financial statements. When you're in QuickBooks, how do we do those journal entries? We do them with data input forms. These are forms that we're not using to give to other people. Typically, they're forms that we do the data input with in order to record the financial transactions and give us a better audit trail than just debits and credits, because sometimes the forms are connected, as we have seen. So these forms then are the journal entries that we're going to create that create the debits and credits, or you can think about it in forms of the double entry accounting system of the accounting equation, assets equal liabilities plus equity. And then these create what you can call the general ledger, which you can think of as in essence the transaction detail reports, meaning if I go to the balance sheet and I drill down on the cash, we have been constructing these reports, the transaction reports. You can see these transactions hitting this report. Now, this, you can think of this as like a general ledger, breaking out the accounts by date of transaction within each of those accounts. And then those can be used to create a trial balance, which we've been looking at the end of each section, because that's going to be the most stripped down and simplified form going back of our balance sheet and our income statement using debits and credits, which are actually cleaner, closing this out, than the financial statements. And then we use the trial balance to create the financial statements, which is the end result, which we have here, more complex than a trial balance due to all of the subcategories that we have in place. Now that we've constructed it, that's like putting the engine together. Now let's deconstruct what we have made, drilling back down from the end result, the financial statements, to the source documents, seeing what's in each of them, and then looking at what other side reports, subsidiary reports, have been constructed as we have done this. All right, so let's go through each of these accounts. The checking account. Now remember, the checking account is the one that is the most complex because there's more things running through the checking account because the cash is the lifeblood of the company. So if I go into the checking account here, you get what you could call a general ledger type of report, which they call a transaction report, which is basically breaking out each of the transactions we put in it by date, but it's only showing one half of a transaction or one part of the transaction. All transactions entered by forms having at least two journal entries, debits and credits being equal, or the double entry accounting system accounting equation being equal, however you want to look at it. So here we have then the transactions types. Now most other accounts are only going to have like one or two transaction types that impact the accounts, typically two. But with the cash account, we have a whole bunch of them. You would think you can boil down all the transaction types to two basic things, which would be what comes through the bank account, which would be a deposit type form for increase to cash, and expense type forms or check forms for decreases to cash. But remember that in QuickBooks, particularly on the decreases, QuickBooks comes up with all these different forms that are basically types of check forms, right? So an expense form is kind of like a check form, but it doesn't have a check number. So that's the form typically used when you have the bank feeds that you're using. The check form is the same kind of thing, but it has a check number. Then the deposit forms are typically the only thing that increases the account unless you enter a journal entry or unless you enter a receive payment or sales receipt directly into the checking account. And then check forms. And then notice here we have a bill payment form. That's another type of check form that is basically just paying for a particular thing, paying the bill. That means the other side's going to be going to the accounts payable. We have a bunch of other of these kind of special checks that could come up. If you're processing payroll, you're going to have a payroll check type check form, a payroll taxes check type check form, a sales tax check type check form. So again, that added detail on all these different forms is kind of cool because it helps you to sort. If I want to filter my information by those particular transaction types, like bill payment forms, that is nice. But if I want to filter all my information by just decreases to the checking account, that complicates things a lot because now I got to like check off multiple things in the filter in order to get all the decreases to the checking account. All right, let's go back. Let's go in. Now, by the way, the checking account also has that added thing that we have to do, which is to reconcile the checking account, which we might do with the help of the bank feeds, but the bank feeds aren't in and of itself the reconciliation process. Let's look at what's in accounts receivable. This is an accrual account. It would only be there if we make sales on account and have to track the receivables. It's not going to be there in a restaurant, for example, where you collect the money at the point in time you sell it. I ain't giving you the food if you don't give me the money, is the general idea. But some businesses, you can't do that. If you're a bookkeeper, it's going to be difficult for them to pay you before you do the work. So that means you have to track the accounts receivable. Notice here, if you have to track it, it's going to go up with an invoice and it's going to go down with a payment of the invoice. That's all there's going to be. We should be able to tick and tie these things out for the most part, right? And then we want to track this. Now, this is a general ledger account, noting that the accounts receivable in particular is the thing that should come to mind as the first thing you really need a subsidiary report for, breaking out the information not just by the general ledger or transaction detail report, but also by customer, because I need to know who I need to collect from. So let's go back and we'll look at all those other reports shortly to see that. And then we have inventory. So if I go into the inventory, noting inventory is infamously complex in terms of the different ways you might track inventory. Do you want to have a perpetual inventory system or a periodic inventory system? In other words, do you want to track the units of inventory within QuickBooks or outside of QuickBooks in some way? We've discussed that in the past. In our case, we're doing the more complex system for QuickBooks, at least, that being tracking the inventory internally. And that means that we also need a subsidiary report for the inventory tracking the units of inventory. So notice what happens with inventory. It goes up when we buy inventory, which is typically going to be with a check or expense type form, and then it goes down when we sell the inventory. If we're tracking inventory in the system, we have to use the sales forms that are going to be tied to the inventory, which is going to be an invoice if we don't collect money at the time of sale, and then it's going to be a sales receipt if we're at like a cash register situation. So the inventory goes up when we buy it, and then it goes down when we sell it, of course. And those are going to be the forms. And of course, the subledger is going to have to be impacted with each of those as well if we're tracking it internally on a perpetual inventory system. Short-term investments, that's going to be an account that you might have to deal with if you have investments. I won't go into that in detail. We talked about that before. Prepaid insurance. Now, anytime you have a prepayment, insurance being the classic case, you have to think, do I want to put it on the books as an asset or simply just expense it? Putting it on the books as an asset is a little bit more complex, but might be the required thing you need to do for external reporting and possibly for taxes. However, it means that if you put it on the books as an asset, you have to make sure that you do adjusting entries at the end of the year, either yourself or your tax preparer or CPA firm. So we'll talk more about that when we get to the adjusting entry section here. You could have prepaid other things like rent, any kind of expense that you pay for before you consume it. You could end up with a prepayment. We've got furniture and equipment. So the furniture and equipment account, noting the furniture and equipment is a little bit different in that we don't have it as a normal cycle because it's a fixed asset. So unlike inventory, I don't buy furniture and equipment all the time. It only happens periodically. So that makes it a little bit easier in some ways because the beginning balance will already have the subledger created and it's not going to change a lot. And then we're only going to have periodic purchases and disposals of property, plant, and equipment. And oftentimes the subledger will not be in QuickBooks, even though we need a subledger, because we'll usually do it in the tax software because we have to put it in the tax software anyways. So we might as well use it to help us track the equipment. But we do have to deal with the accumulated depreciation of the equipment, which is going to be the consumption or the applying of the cost or expensing the cost as we consume it over its useful life. So we're going to have to provide this information, the changes, to our tax preparer or CPA firm, who can then adjust the financial reports in subledger as they do the taxes and provide us with that information. Let's go back so we can do adjusting entries. We'll talk about that again in the adjusting entries section. We've got the liabilities. we've got the accounts payable. So we'll do more accounts payable in the second month of operations, but in essence, the accounts payable goes up when we enter a bill, and then it goes down when we enter a pay bill. So there's only two forms, like the accounts receivable in the accounts payable, like the accounts receivable. The accounts payable will need a subledger breaking out the information not by general ledger type account, transaction detail type of account, but also by who we owe the money to. We've got the Visa. We didn't do a lot with the Visa item. Actually, the Visa or credit card is similar in nature to a checking account. It's a little bit more complex in most people's minds because it's a little bit more wonky to think about when you pay for something, you're going to decrease the checking account versus when you pay for something with a credit card, you're going to increase the liability. But it's similar in that you're going to usually use the Visa to pay for normal kind of expenses, and then you can go through the bank feeds when you do the Visa card. We'll do that more in a future course or presentation on bank feeds. Then we've got the sales tax information. So if I go into the sales tax, we set up the sales tax in the system, remembering that you could have different ways to deal with sales tax being a consumption tax. If you're outside of the United States, you might have a consumption tax as like your primary federal tax, like your tax for your government tax maybe, so which would be similar to this. And the way to do the sales tax within QuickBooks is to set it up as you do sales transactions, invoices, and sales receipts. But you could try to do it by hand if you wanted to. It's not as complex as payroll. So if you wanted to use some other system, it's possible to kind of calculate the sales tax, make sales, and then still hopefully be in compliance with paying the proper sales tax, even though you're not using like the QuickBooks widget to do it. Let's go back. And then we've got the loan payable. So the loan payable is usually pretty straightforward. We'll go into some payments of the loan payable in future presentations where we'll have to break out the interest and principal and tie it into the amortization table. We have some systems in terms of how we're going to basically organize the different accounts in loans payable. We'll talk more about that when we get to the adjusting area and when we pay the loans payable in a future presentation. Payroll tax payable, payroll liabilities, I should say, noting these will only be there if you have employees and if you're processing payroll on an accrual system within basically QuickBooks. So remember that it's possibly to have a third party do the payroll and then you try to stay in a cash-based system. We'll talk more about payroll in future presentations. That'll take up too much time to dive into that now. And then on the equity section, we've got the owner's equity, remembering that the owner's equity represents the retained earnings that has been accumulated, meaning income, revenue, that has been accumulated, but not yet given to the owner in the form of draws if it's a sole proprietorship or partner, or in the form of dividends if it was a corporation, owner's equity being equivalent to the retained earnings. Notice it won't let you drill down on this, and I kind of wish it would, because you could still post to it, but most of the information in owner's equity should be there just from rolling in the closing process. So in other words, if I increased the date to 2026, this net income would roll into owner's equity. All right, and then the net income isn't actually a account in the balance sheet. It's not normally there. This net income would normally be part of owner's equity in normal reporting purposes, but QuickBooks wants to break it out, trying to give you an idea of the comparison or how the income statement relates to the balance sheet. So here's the net income, which is going to tie out to the profit and loss, which we'll look at shortly. And then the owner's investment, representing the money that we as the owner gave to the business to get the capital that we needed to buy the property, plant, and equipment and the inventory initially. All right, let's go to the profit and loss. On the profit and loss side of things, we've got basically just two sides. Normally, you've got income and expenses, and that's going to give us net income. So the profit and loss is the timing statement. Everything on the profit and loss goes up. Income goes up, expenses go up, and then we say income minus expenses is the net income. So we have income, which we categorized into these three accounts: noting that we don't want to be breaking out income by every customer, usually, or by everything we sell, typically in part because we can often get that other information breaking out income by customer and or by item with subsidiary reports, which should tie out to this number, which we'll take a look at shortly. Cost of goods sold is the things that we sell, the cost of the inventory that we're selling, which should be populated. By the way, these accounts, when will these go up? When we enter sales transactions. That's going to be sales receipts and invoices. Sales receipts, cash register sales, for example, invoices on account. And then cost of goods sold, when is that going to be going up? When we enter, once again, the sales items, which seems a little wonky. Why? It's an expense. Why does it go up when we enter the sales stuff? Because that's when the system knows to record the expense, because it's going to record the accrual thing of decreasing the asset that we purchased before and expensing it as we sell it rather than expensing it when we bought it. That's an accrual component that's happening, matching up the cost of the inventory to the point in time we sell the inventory. And then we've got all of our expenses. All of the expenses typically will be going up with check type forms or expense forms. These are the ones that usually we can automate with the help and use of the bank feeds to a large extent. And then we've got the net income, income minus cost of goods sold minus expenses, 742443, which should tie out to what's on the balance sheet, 742743, 742743. Let's take a quick look at the internal reports, back to the tab to the left, going down to the reports on the left, and let's just recap some of these, highlight some of these reports. Business overview, balance sheet, that's a repeat. Balance sheet comparison, we'll talk about how to build a comparison report later, so you can build that from a standard balance sheet. So balance sheet detailed gives you a little bit more information. I don't think that's used all the time. Summary balance sheet, we'll talk maybe a little bit more about that in a future presentation, but it's basically just taking out some of the line items from the balance sheet, making it a little bit more simplified. And then we've got the statement of cash flows. That's going to be another major financial statement report. Let's open that one up, right click and open that one up. This is the third major financial statement report, but not as common as the first two reports. Let's go from 010125, meaning what I mean by not as common is that we don't really check it all the time, because it's basically something that will be constructed from the balance sheet and income statement if you were to basically do it by hand. And the idea of it would be, we already have the books on accrual basis. Now you might be on basically a cash basis, but really we're going to imagine the books are created according to accrual rules, and it's only if you only have cash transactions that the accrual and cash basis will basically be recording the same thing. But if there's a difference in timing between an accrual basis and a cash basis, you could switch this account to cash to see a cash basis that way. But when we do normal financial reporting, what we're going to do is say, I'm going to make a statement of cash flows to give me the best of both worlds. So I have an accrual income statement, the timing statement, and I have a statement of cash flows that gives me the cash flows on more of a cash-based system, broken out into three items: operating, investing, and financing. Operating being the main section, which kind of ties out to the income statement, which you would think would just be realigning the income statement, revenue instead of on an accrual basis on a cash basis, and expenses instead of on an accrual basis, a cash basis, to get to net income on a cash basis. But no, normally we do a reconciliation process. So we start with the net income, and then we back out the differences between an accrual and cash basis. The reason this is preferred is because it actually gives us a reconciliation of the two. Notice if I just made another income statement and I just made revenue on a cash basis minus expenses on a cash basis, I don't really have a reconciliation of the net income on an accrual to the cash. I have two side-by-side parallel reports. Whereas when I do the indirect method versus the direct method, that's what they call them, then I get this worksheet. So I won't go into that in more detail here, but that's the general idea. That's one that you could certainly generate as you make your external reports for clients, for example. Business snapshot, not use too much profit and loss. We've been looking at that profit and loss by customer. You can create this as we saw when we did the jobs. You could just create that one normally from a normal profit and loss by store. I think you can create that one generally too if you have stores. Profit and loss by month. Again, you can create that typically from a normal profit and loss, as with the case, I think, with profit and loss by tag. So these are just repetitive reports that you can construct from a normal profit and loss comparison. Same with that one. Profit and loss detail. That one might be a little different. Profit and loss as percentage of total. Again, you can kind of build that. I call that a vertical analysis, profit and loss. Profit and loss year-to-date comparison. Then again, you can construct that yourself with a profit and loss. So all of these are kind of repetitive reports. I want to point that out so that you don't get overwhelmed. Same with the quarterly profit and loss summary. So who owes you? Now remember, what do you think these are gonna give you information about? They're gonna give you information about some line item on our major financial statement reports, in this case, on the accounts receivable. Those are the people that owe you money, you would think, right? Accounts receivable. So what do we have here? We got the accounts receivable aging. That's going to break out the accounts receivable by how overdue it is. That's most likely the most common report that we would use that would tie out to accounts receivable. Accounts receivable aging detail, similar. Collection reports, customer balance summary, and the customer balance detail. We've looked at these in the past as we've constructed our reports, remembering those are the classic subledgers breaking out accounts receivable by customer, but internally, we usually use the customer center, which will be located under the sales tab. All right, and then we've got the invoice list. We've got the invoice and payments. That's going to give us the detail of the increases and decreases, which again, we can kind of see internally usually. Open invoices, which should tie out to the accounts receivable again, because those are the ones that they haven't paid us yet. Terms, unbilled charges, these are things that we'll usually see internally for charges for time, and then for expenses, charges, and time that we haven't yet sent an invoice for. Projects, we've got project profitability summary. So if you're running projects, which you might do if you have a job cost system, a specialty area, then you might run the project profitability summary. Then let's take a look at that. Well, now let's keep going. Sales and customers. So what is this one going to be dealing with? You would think it'd be giving you more information about the income line item on the profit and loss report, because it's income. Customers kind of indicate accounts receivable, but sales is like revenue. So we got sales by customer type. So you can break out the sales by the type of customer if you broke out customer types. Estimates and project invoicing summary by customer. So if you have estimates or progress inventory specialty areas. Custom contact list, that's just going to be a list of your contacts for customers. Income by customer summary. So now we're going to break out that income line item, not by account, but by customer. Subledger, breaking out your revenue by customer. Customer phone list, it's just a phone list. Sales by customer summary, sales by customer detail. Now, you can have income or sales. They sound like the same thing, but one of these two reports is going to give you the related cost of goods sold if you sell inventory. That's what the difference is. Then you got the deposit detail. That sounds like a balance sheet account, and it kind of is, but the assumption is most of the deposits are ultimately coming from customers. Therefore, they put it here. You can basically create a deposit detail report, in essence, by looking at the drilling down on the cash line on the balance sheet and then sorting or filtering by deposits, right? And then sales by store, estimates. If you have estimates turned on, we might talk more about them in the second month. Inventory valuation summary. So this is an inventory report, which you would think would be a balance sheet report, but they didn't know where else to put it. So they put it here because you sell inventory to customers, I think was their logic there. So that's going to give you the subledger of the inventory, breaking out inventory not only by dollar amount, but by unit. Product service list. So that's the list of the stuff we sell. Sale by product. So this is the other big one. that gives us the revenue, not broken out now by customer, not just by GL account, but by product, the goods and services that we actually sell. So those are the two ways, by customer and by product and service. Payment method, physical inventory. So again, inventory backup sheets and so on. Transaction list by customer and by tag. All right, what you owe. What would these accounts be supporting? You would think what you owe would be the accounts payable, if there are accounts payable, if you're tracking accounts payable. If not, these reports would probably be not very useful to us. So accounts payable aging summary, breaking out the accounts payable by how old they are. Accounts payable aging detail, bills and applied payments. The bills make accounts payable go up. The applied payments make them go down. So that gives us the detailed report. Bill payment list, 1099s. We might talk more about 1099s later, but that's going to be something in the United States that is going to be specific for reporting needs to contractors that are not incorporated, that have been paid over a certain dollar amount and so on. Another one, unpaid bills. So unpaid bills would be equivalent to what's in accounts receivable. If you sum them up, you would think this is the big one. Vendor balance summary, vendor balance detail. Those are the subledgers of accounts payable, breaking out the information not just by date of transaction, but by who you owe the money to, which you possibly don't create these reports as much because you would track it internally and the expenses center. And then you have the expenses and vendors. What would you think these reports would back up? Income statement account, expenses, right? They would back up the expenses typically, giving us reports on more information there. 1099, purchase by store, purchase by product and services. So purchase of products would be if you buy inventory. We're buying the products. Open purchase orders, so we're tracking the purchase orders now. Is open purchase order list, purchase list, transaction list by vendor. So now we're breaking out, in essence, the expenses, not by GL account, telephone bill, and the utility bill and so on, but by vendor, meaning we're breaking it out by like Verizon versus Edison and so on. And purchase by vendor detail, vendor contact list, so we print out the contact list. Expense by vendor summary. All right, then we have the sales tax, our type of consumption tax, which would only be there if we are dealing with sales tax, which might help us generate reports, although we'll possibly create these in the sales tax widget, which is on the left-hand side here. Employee reports, we've talked about that in detail. I won't go into them in more detail, but if you do the payroll internally, there's going to be a whole bunch more employee reports that you can generate. And then we've got, for my accountant, the account list, balance sheet comparison. So these are repeated reports again. We've already seen them in the overview, balance sheet detail, balance sheet summary, statement of cash flow. We already saw that repeated. Store list, general ledger. This is the new one this is a new one. It gives us all the information, which is similar to what we were calling general ledger type accounts when we drill down on a particular account, like the cash account on the balance sheet, called a transaction report, because it's going to give us the information by date. It used to be that before we can kind of get access as a CPA firm to the QuickBooks file or the accounting file, then they'd have to give us the general ledger, which would be this massive book of all the accounts. But now we don't need to generate it as much, because if we have access to the file, we can drill down from the file on the balance sheet or trial balance. General ledger list, we've got the journal. So this is going to be another report breaking out all the transactions by journal entry. We might talk about that more later. Recurring template list, profit and loss by tag. These are repetitive reports. Again, we already saw these, profit and loss, recent transaction, and reconciliation reports. We'll talk about bank reconciliations later. Those are actually a little bit different than normal reports. If you click on this, it'll take you to another tab, the reconciliation tab. And then the trial balance, I'm going to right click and open that one. So they buried this way down here, but this one might be one that you want to use internally because it's a cleaner look. If I change this 010125 to 013125, we saw that this one is basically the balance sheet on top of the income statement. The reason they put it way down on the bottom of the reports is because they think it has debits and credits, so nobody wants to use it. But it's pretty nice report. We've talked about it. It's a nice way to check your numbers. It's a clean way to look at all of the numbers. Doesn't have all of the subtotals. If you want to verify transactions as you do data input, which I recommend doing. Let's go back to the first tab, transaction detail by date. So that's similar to a general ledger report by account. Transaction detail list by date. So now you're going to have all the transactions, but they're going to be listed by the date of the transaction, and then the one with splits, and then you got more payroll reports. All right, so hopefully that gives a general, makes us feel a little bit more comfortable about the reports. The major reports, balance sheet, income statement, and then you have all those subsidiary reports, many of them being reports that I can generate simply by adjusting the balance sheet and income statement that is provided, such as comparative reports, which we'll talk about more next time.